Hello and welcome to this carrier update brought to you by Powerfleet. I'm here, Tony Mulvey. You're back with us. Let's jump into it.
I am, yeah. So we're going to start with our outbound tender volume index, kind of seeing this downward movement the past few days, right? We talked about this kind of Easter basket back there, middle of April, kind of rebounded from there. The rest of April, we kind of flatlined at that level. Since we've started May, kind of starting to see that downward movement start again, right? We're sitting at about 17% below where we were a year ago. So if you look in the green line, that's 2021 levels, and the orange line there, 2020 levels. So kind of right there in the middle, right? So we think about this time in 2020, kind of starting to see volumes ramp up as the pandemic, that's where we started to see stimulus checks rolling out, that the buying, right, if we look back in March and April, that was more panic buying. This was really that start of that goods buying that the consumer really took off with and kept up for almost 24 months. and now we're starting to see that slow, and as a result, you're seeing these tender volumes decline. With that, I mean, you think about this index, it does include both accepted and rejected tenders, right? So it tells you which way the market's moving, but we'll move on to our next chart and show those rejections, and we'll see they've come down pretty significantly too. I mean, we're right at 8.59%, so under that 9% mark. Still, typically we think are anything around between 7 to 10%. I mean, if you would have said we were at 8.5% back in 2019, we'd say the market was really tight, right? But now 8.5% from where we've been for 24 months seems really loose, right? And we have seen this trend. I mean, if you look back here in the blue line, we were at 20% at the beginning of February. So, I mean, we've cut them by more than half in just a couple months. And it's almost as fast as what we saw, not as fast as what we saw in 2020, right, with that panic buying surge, but definitely this is the most severe downward slope that we've seen. So, I mean, right now, we're about 1,600 basis points below year-ago levels. And what's that mean for total volumes? They're actually negative. So those accepted volumes really turned negative. A couple weeks ago, when we saw that Easter dip, they turned negative. They kind of rebounded, flatlined. And then this week, just recently, we've seen kind of that retrenching, right? I think we're down right around 1% year over year. And ultimately, I mean, if we see freight demand continue, that OTVI level continue to decline, those accepted volumes are going to keep falling.
And Tony, when we're looking at the market, what are some of the differences or maybe similarities that we're seeing within contract and spot?
Yeah, so I mean, you look at spot rates, right, and contract rates. Contract rates pretty sticky right now, right around that $2.95 a mile. According to our data, and those are that baseline haul rate. And then you've got truckstop.com's national spot rate at $2.90. And that's obviously below that contract rate, but it includes those fuel. And we talked about it a lot, and I know having Kingston on here soon to talk diesel prices, but I mean, you look at what diesel's done, right? We're like record highs. Those really squeeze in, especially on the spot side, right? I mean, you've seen spot rates decline so fast while diesel surge, well, it's telling that underlying rate is falling even faster, that line haul rate. And now you're getting into a point where that gap between contract and spot's pretty significant. I know all of last year we talked about it the other way, where spot was way above contract. Now it's the inverse. And what you'll see is after about a month of that, shippers, we did a survey back in 2019, shippers will start moving things to the spot market for cheaper prices, right? And that's going to be what's interesting is if we see spot volumes start to go up, but the rate keeps coming down, it tells you shippers, hey, we're moving it into the spot market, but it's going to be at a lower price than what you have been at.
That's going to be an interesting trend to kind of watch here as we come up into those months here. Tony, when we're looking at, of course, we always kind of talk about where, excuse me, the power lies within the shipper or the carrier. Are we seeing a shift in that significantly?
And not significantly. I mean, we write the PPI every week, and we've kind of been in this 45, 55 range for a few weeks now. We shifted it right around that Easter time to that 45 level. Really haven't changed it because, I mean, ultimately the dynamics really haven't changed. You've seen spot rates continue to decline, which kind of shows that that power's with the shipper. Granted, contract rates have been sticky at that $2.95 level, but as we've heard a lot, you're seeing anecdotally, we've heard that you're seeing some bids start to, hey, we awarded it to you, now we want to rebid it because it's just, the rates have fallen so fast on the spot side that it is kind of lucrative to move it over if you're a shipper.
Well, Tony, thank you so much for this first update. We'll check in with you again throughout the morning. Right now, we're going to toss it back over to Sydney Edwards.